Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Good afternoon and welcome to the AICPA Town Hall Series. I'm Eric Auskerson, one of your hosts for today, and with me in the New York studio is Barry Melanson. Welcome, Barry.
Eric, always great to be with you. Glad to be here, and I hope our members listening in this crazy busy time at least found some time during the summer to do some fun things.
Yes, it's been a busy period since you were last on the Town Hall, July 21st. We'll get into that in a moment. But real quickly, today's agenda, we're going to kick things off with an extended DC and profession update. We're going to cover the Inflation Reduction Act in detail. We'll get to many key parts of it. We're then going to do a brief technical update section with Carrie Hisbach, and then we're going to have Carl's Corner on top small firm issues, and then we'll close out with the open forum. But Barry, what I want to get into right now with you is to talk a little bit about, this very dynamic month. When you were last with us, on the July 21st Town Hall, we were looking at the bill, the reconciliation bill, is just a healthcare bill in essence. And, the big question was, will Senator Manchin change his mind? I think we saw the answer to that. And we covered that during the August 4th Town Hall. And at that point, it hadn't become law yet. We hadn't gone through the vote-a-rama, and they still were working on some items with Senator Sinema. But all that occurred, and it's now law.
It is law, and for about 6 months we've been saying there was a lot of news reports that the bill was dead, it wasn't going to be taxed, and we kept saying the odds were that it wasn't going to become a major tax bill, but it wasn't zero chance, and that zero chance played out with the passage of the bill. I think it's ironic that the acronym for the bill is IRA.
Yes.
And so it's pretty interesting. There's a lot of components in it that are going to be, I think, talked about. There are components that are still happening with executive orders as well. So it's going to be something that I think will call really front and center. What we've talked about all along is the trusted advisor role that people have. Their clients are going to have unanswered questions. Frankly, there's going to be unanswered questions about the bill because it's going to take regulations and interpretations from the IRS. So there's going to be a lot of moving points over the next several weeks and months.
And it's amazing the amount of press that it's receiving. It's a big bill, $740 billion, 730 pages. So it's about $1 billion a page. But what is being discussed right now are some of the major components. We heard a lot about the corporate AMT, and we talked about that a little bit on our last town hall. But what's been in the news lately is about these 87,000 agents that the IRS is going to be funding based on the dollars allocated.
Yeah, so let's talk about that. So let's talk about that. First, we'll talk about the corporate AMT at a later town hall, but let's talk about the IRS issue. Almost immediately upon its passage, it became a political football from the stamp, and we're getting ready to get into football season. It really became a political football with people saying, that there are going to be 87,000, armed IRS agents and all of those types of things. And let me just head this off at the beginning, because I think it's very important for everybody to understand. Our focus in this particular issue has always been and continues to be about service. The service, the allocation of resources for service, to do a better job with service, to modernize the capabilities of service. You've heard that from us, ad nauseum personally. And frankly, that continues to be the point. Jan Lewis, our tax executive committee chair, was just on Neil Cavoto's show making that point. And we do believe, without any uncertainty, that the allocation of enforcement money compared to service money is not in the right balance. But it's also, it's a little bit of an extreme to say that there's going to be 87,000 new employees and they're all going to be in the enforcement division and we'll come back to that, but with carrying, armaments and things of that nature. I think we have to be balanced in that point, but it's a very small amount, about $3 billion, and about $42 billion or so into the generating of money. And we have to be we have to understand the process. This is a 10-year bill. There is you have to have funding involved in that 10-year bill, and the funding and the scoring, as it's called, related to enforcement, gives them revenue. Now, whether that no one ever comes back and checks on that later on, that's one of the fallacies of our system. But that was the way to have so-called pay-fors in the bill.
Well, and Barry, this idea of going after the tax gap, I mean, this has been around for a decade plus. It's something at times both the Republicans and Democrats have wanted to go after the tax gap, but this has become very, very partisan right now.
It's very partisan, and it's going to make it difficult for some rational answers to come about, because there are going to be people politically that want to defend every statement that's been made and not make any changes. And there's going to be others that are going to say, I want to repeal the whole thing because it's an attack on small business or people with enterprise businesses and things of that nature. So let's just talk about that. Let's come back to the 87,000 employees.
And they have 81,000 today.
Right. There's no way the agency is going to double. First off, in the next 5 years, more than 50% of the current employees are going to be of the IRS are going to be eligible for retirement. So clearly, some of that money is going to be part of the recruitment and hiring process, but that's not going to get it to a doubling of the size of the IRS from an employment perspective. It's just not practical. And even if they wanted to hire 87,000 employees, that's not even practical from that standpoint. So when you got 50%, greater than 50% of the workforce retiring, you're hiring new over a 10-year period of time, it's just not very practical to see that happening. On the armed part, we all know, everyone in this profession knows there's an enforcement division that does have agents that are dealing with very sophisticated, risky types of environments. That agency today, which has permission to carry arms, is about 2,000 people. It's just not practical to believe that's going from 2,000 to 89,000 or whatever the number might be. Again, not a practical element. But the issue that you raised, in which when people are saying there's not going to be any of this enforcement activity on people with less than $400,000 of income, we have to call that out as well. We have to call that side of the equation out as well, because it's your tax gap point. This funding mechanism, or this closing the funding gap, is really about a significant amount of money that goes unreported. Now, where does that exist? Let's be honest. Big business has all sorts of mechanisms on reporting, electronic capabilities that tie into those types of things. High wage earners have all sorts of, in 1099 types of reporting mechanisms that captures the vast majority of that income, all trade activity, investment activity, et cetera. So by nature, if you're going to have a gap that's going to get closed, where's that gap? It's an unreported income. Where is that gap more likely to be? Everybody on this call that has small practices and they have, cash basis taxpayers and the like, that's where that gap is most likely to be. And so it's either a fallacy that they're going to close the gap, or it's a fallacy that it's not going to affect, small business taxpayers, because that's really where it goes. So the fallacies are sort of equal on both sides.
So a couple things. First off, the number of new agents, 87,000, it's very clear that the media is incorrectly stating that, or some people are incorrectly stating that these are going to be armed agents. There could be some increase from that 2,000 to a higher number. Maybe you'd think even if it doubled, it would go to 4,000, and that doesn't even seem likely. So that item, I think it was important to spend some time on. But then the other item that's being discussed is, if you're going to close the tax gap, who's going to be included in this, increased enforcement activity. And it looks like a lot of small businesses, a lot of clients of the firms here on the call.
Well, it has to, you would think it has to be, if you're going to meet the revenue side of things, the tax gap closure that you described. The IRS has not announced plans in detail, so everything that everybody's saying is speculation. Secretary Yellen has said in 6 months, I want a detailed plan. But even today, for instance, in a Wall Street Journal article, which is something that we definitely want, the IRS has said we're going to use some of that to put into the service element. And let's be clear, there is nothing in the bill that actually prevents as you just said, it's $1 billion per page bill, basically. There's nothing in that bill that prevents the IRS from using some of this money on the service side. And that's our number one point. We're going to continue to make that point. We have to have a modernized system. We have to have things like practitioner access improvements. We have to have, control portals where people can deal with their issues. And we have to have this incredible backlog that's out there in the system that this bill or anything related to it is not really going to solve. And those things are necessary for an effective functioning IRS, an effective functioning tax system. And we're going to call out people on both sides of the issue. So, we have this reputation on the Hill, this profession does, of sort of looking at issues that are not practical or not workable, or where they are workable, to come out and give sort of the plain truth on that point, whether it's Republican or Democrat or Republican. And we're doing that in this case. And at the same time, we're making the point about some of this funding, a significant amount of this funding needs to go to modernization, and it needs to go to the service enhancement.
Well, Barry, let's bring up this slide that you covered a lot of these points, but this slide highlights the breakdown of the increased IRS funding. And one thing that should be noted is that there's nothing in the Inflation Reduction Act that prohibits the shifting of these funds.
There's nothing that prohibits, and in fact, Secretary Yellen has requested that plan be put forward, and I think that's where you'll start to see some of that really moving forward. You can see relatively small increases on that slide in things like business system modernization and taxpayer services, 4.8 and 3.2 billion. Not small numbers by any stretch of the imagination, but in the government sector, it is relatively small. I think you're going to have to see some shifting in that. I think, frankly, business system modernization actually goes to some of the tax gap closure as well. But at the same time, I think we have to see some of the improvement in the capability of practitioners to provide services, et cetera. And one of the things that I think comes to this, particularly when you come to the tax gap point that you just raised, Eric, is that let's make the comparison to PPP. One of the things that this profession did extraordinarily well, and has for many, many, many decades in the tax area done well, is that we're about trying to get to the right answers in the tax compliance aspect. So in PPP, the incidence of fraud didn't occur with people who went through their CPAs to get PPP loans. It overwhelmingly was in other avenues of being able to access that funding. And the same thing is true. Tax practitioners want to do the right thing, and their clients want to do the right thing. And so I think these are the types of conversations that you should have with your clients about, look, the fact is that when enforcement increases, it's going to affect all range of taxpayers. And to say it's not is just as much rhetoric as implying there's going to be 87,000 armed IRS agents. And so, that's, again, this bipartisan notion. We're attacking both of those points on both sides of the political equation.
Barry, very well said. I think it's a very important time for the trusted advisor role, just like it was during PPP. And there's no question that all of this media attention over the past week has got everybody thinking more about their compliance and their business and personal tax returns. So this is something that the firms need to work into their client dialogue. There's a lot more than just the increased IRS funding in the Inflation Reduction Act, and we want to get into this, but we're going to bring James Dennis, a former Senate tax counsel, on to one of the leading experts actually in the United States related to tax. Tax Notes has named him one of the country's top 10 tax experts. So let me just give a little bit more of the background on James Dennis. We were very fortunate to have a relationship with him, and he's agreed to kind of help us unpack the 700+ page bill. He's also served as counsel to the Bipartisan National Commission to Restructure the IRS, so he's got a lot of background there. Since leaving Capitol Hill, he's represented many, many clients, and he's been studying the whole process related to the passing of this bill, as well as reading the act. So to kick things off, James, thanks for being with us today. Just want you to share some of the next phases here on building out all of the detailed explanations and guidance in the process around that. So welcome, James.
Sure. Thank you. Thank you for having me. And I've enjoyed working with AICPA for pretty much most of my career. So thank you for having me on. I think the one thing that we all have to keep in mind with every tax bill that's passed under reconciliation is the fact that a lot of the clarity just does not exist yet. The rules of reconciliation do not allow you to put in the type of specificity that we all like to see. So for the next year or two, we're just going to have to wait to see what guidance comes out. And this chart lays out sort of the two big areas. The first being the Joint Committee of Taxation will be putting out what's known as the Blue Book, which is a annual description, sort of a legislative history of the tax law. And this year we'll have the CHIPS Act, which was passed recently. It will also have the IRA, as well as any other extenders languages passed later in the year. And that will give us maybe some clarity as to what the intent was when joint tax give a revenue estimate for provision. What did they mean for it to do? And is it drafted in a way that does that? The next one is the larger one, which is Treasury guidance. And that is going to probably continue for the next two and a half years. As you know, a lot of the provisions in the bill are going to kick in some kick in now, but a lot start in the beginning of next year. And for taxpayers, they're going to need guidance to know how to take advantage of these provisions, things like transferability of credits. Homeowners need to know how to take advantage of investments for heat pumps in their house or new doors or new windows. So it's unfortunate, but this is the process, but we will get through it and we will get good guidance and we will pass on things as soon as we know.
Well, thanks, James. I want to bring Barry into this discussion as well, because you've seen a lot of tax bills pass during your time as CEO of the AICPA. So how do you see this next phase?
Well, everybody wants answers to all the specific questions, and it is just going to take time. This, as we all know, was put together very quickly. James has lived that from his time on the Hill. It was put together very quickly. It's ripe with broad elements, just like I talked about the budgeting part. There's nothing that prohibits in the bill from moving, from enforcement to services. Well, there's all sorts of things that are going to be in this bill that are going to be subject to interpretation and rules and regulations. Now, the unfortunate thing is that our members look across the table to their clients and they want specific answers. They want immediate planning capabilities and all of those types of things. We're going to continue to work with the IRS and trying to get as much of that out as quickly as possible. We're going to bring you all the breaking news that we can from any of the movement in this area, and any insights by having people like James on that might be able to give us some early insights. But there's going to be a degree of ambiguity. That's the nature of all of these pieces of legislation.
So, well, let's start trying to break down some of that ambiguity, Barry, and move into, the biggest portion of this IRA bill, which is the climate tax credits. I mean, James, it's over, well over 300 billion, and when there's elements of this that aren't even included in that $700 billion price tag, so it could be higher. The pre-discussion we had with you was very interesting, and I know the town hall attendees are going to appreciate hearing, about some small business as well as individual tax planning you really need to get going on right now.
Yeah, there's a lot. And I think at least the good part is most of this really won't be effective until 2023. Some on the individual side, but those credits are set up in a way that most people will understand how to take them onto and bring them onto your return. But a little historical perspective, this was a concept of sort of having a technology neutral sort of a way of measuring whether we should have tax incentives for climate change or for our cleaner energy. Was 10 years ago this started, and this is sort of the fruit of that, which is instead of having all these different incentives that are basically tied to different technologies, solar, wind, with different provisions, this bill moves towards a new system that is basically based on greenhouse gas emissions. And if you are not increasing greenhouse gas emissions, then if you generate electricity that way, your technology will most likely qualify. And as in the first bullet point says, you will either get an ITC, which is an investment tax credit of 30%, or you'll get a production tax credit, which is based on the generation of the kilowatt hours, so many cents per hour. This is in place for 10 years, or when we hit certain emissions goals, greenhouse gas emissions goals, the latter of which. So at a minimum, this will be the law of the land until changed for 10 years. So you'll have that for electricity generation. Renewable fuels is a similar concept. So if you think of things like biodiesel, ethanol, things that have plant-based in it, they're all moving towards a new system as well, which is like, look, let's base this on greenhouse gas emissions, get rid of specific technologies. Then sort of the next big bucket, as I see it, is the one that probably matters the most to people on this call, is looking at individual purchases as well as commercial, but a lot of it is individual purchases of energy efficient technologies, things for their houses, windows, doors, heat pumps, and those types of things. Similarly, there's also going to be, there are provisions now for electric vehicles. This has changed significantly. We're still learning more of how it works. There are a lot of new limitations in it. The vehicles have to be assembled in the US by the end of the year. They have to have batteries made with products in the US. There are income caps now on who can qualify, and there are limitations on the cost of the vehicle. But they're also expanded to allow used vehicles to get these credits, commercial fleets. So there's a lot going on, but we've really gotten away from the older model, which was based on manufacturing limitations. And once a manufacturer like Tesla hit their limit, you no longer were eligible as a taxpayer. So that's no longer the case. We're now into the new law. And the last part is kind of spread out through the whole bill, which is a lot of this is about domestic manufacturing. How do we get solar panels made in the US? How do we get EVs assembled and made in the US? And most of these provisions have some level of a domestic, either manufacturing or domestic content requirements in them. So it is a pretty massive change, but fortunately for most practitioners, the provisions won't really kick in until 2023.
So James, let me ask you a question. So on the two questions really, on the personal side, which some of the energy efficient property improvements, is there any specific elements for things that are in process now? What's the effect for our members as it relates to their clients that are dealing with 2022 taxes? So that's one question. And then some of these, the whole notion of climate and carbon and all of that is emotional in this country. There are people on both sides of that issue. I've talked about it before. I'm a big advocate of let's measure it and let's see what it is, and then people can make their decisions as to whether it's having an impact or not. But in this case, for instance, on the electric vehicles and the credits, because the bill was passed to create a 10-year window, it's really allowing for some of that stuff to mature, where people might say today, for instance, there is insufficient capacity of our electric grid. If we did all of these things tomorrow, we'd actually have more problems. So isn't sort of this 10-year window is attempting, I'm not saying perfectly, but attempting to address that. So those two different questions.
Yeah, well, I'll take the first one. So for most practitioners who probably had taxpayers who were taking advantage of the 10% credit for the purchase of things in their house, there was a $500 lifetime cap, which meant you might have some taxpayers taking it, but you're going to hit your $500 lifetime cap fairly quickly. So they've gotten rid of that system. So for 2022, past law was reinstated. So it's a 10% credit. Still the cap applies, but starting next year, that's when the cap is lifted. You go to a more traditional, I think it's $1,200 annual limit. And there's a whole list of things from doors, windows, heat pumps, energy audits for your house that will qualify. And so this will sort of become more of something that taxpayers are going to be taking every single year on their return, which I think will have some interesting effects. People will probably, you'll buy a door one year and then buy your windows the next year. But this is going to start taking effect starting in 2022, and the credit goes from 10% to 30%. So a lot of taxpayers are going to hit that $1,200 number pretty much every single year. Getting to the second question,
the time frame issue.
The problem we had really had was that energy tax incentives were basically extended every couple of years. They would expire, they would be extended, oftentimes retroactively, which is pretty much horrible policies, we all know. So I think the theory is like, look, this is the law of the land for 10 years. Let's put it in place. There are going to be a lot of hiccups. There are going to be a lot of problems. Trying to require products to be made in the US is a wonderful concept, but in the end, it's not always as easy to domesticate and bring manufacturing back to the US. So the theory at least is, let's put the law in land for 10 years. Let's see how it goes. And it's intended to phase out. So whether it does or not, we'll see. But that's sort of the underlying theory of the whole bill.
So let me just ask you this question. Assuming you don't have an electric vehicle today, would you buy it in 2022 or would you wait in 2023?
So this is so as we know, the history of the bill, Senator Manchin had a large role in it. He was not a fan of electric vehicles. So the new provisions, I think, optimistically might work in the future. The problem is there aren't a lot of electric vehicles that are manufactured, assembled in the United States to meet the requirements. There aren't a lot of electric vehicles that will have the battery components that are in the United States. So I think most people view that this is an incentive that probably in a few years, when companies decide I'm going to have to assemble my cars in the US. But put it this way, there were probably a lot of electric vehicles purchased the day before the enactment. Well, that was the last day when the old rules applied. So soon the income caps are going to kick in, the cost of the vehicle will kick in. There will be change. My guess is it will probably take a few years before it really operates as they intend.
The point of my question really was the message that these are the types of conversations that I think members are going to be having with their clients, and the clients are going to want answers to. So let's come back to the sort of the interpretive, the point on the earlier slide of how long it takes to get this. When can, again, from your experience on the Hill, when do you think we will start to see some of the interpretive language that really will help people implement these relatively complex provisions that are in the law?
So sort of like if you remember with TCJA, when that bill was passed, it took a little while to figure out how the Trump Treasury Department was going to handle guidance. Were they going to put it out in big chunks? How are they going to do it? And so we're going to slowly build with the new administration. But the day after the bill was signed, we got our first guidance, which was on EVs. And the most important question for a lot of people was, if I had a binding contract to purchase a car and I got it before the date of enactment, then the old rules applied. Well, that could have been the day before it was signed into law, the day it was signed into law, or the following day. Like, what day did I have to have my binding contract? And we now know it was the day after it was signed into law. So we're going to see it. We're going to see it a lot quickly. A lot of these credits are coming into effect starting next year. A lot of the revenue raisers, the book minimum tax, those things are going to be impacting people. People are going to have to be making withholding and estimated payments fairly quickly. So I think we're going to see a lot in the first 4 months, but this is a massive undertaking. So I think we will get smarter as the system continues to start churning out the guidance.
So Barry, we want to move to a couple of other kind of opportunities that the firms need to be thinking about, and James is going to clear this slide in a minute. But before he does, questions coming in here. It's kind of like PPP. There's lots of uncertainty. So just how would you suggest to start providing this information to your clients?
Well, the first is to be, I think like we attack it on the Capitol Hill, to be the nonpartisan player here. I think, for instance, at the macro level, you approach it with your client on the notion of the armed agents, and be honest that that's not a reality. That's all going to take place. And at the same time, that the audit's actually going to go through the entire process, to be wary of that from a compliance perspective. So I think that that's the first sort of bucket.
Compliance.
Yeah.
Quality compliance.
Absolutely. And that's a value proposition that you bring to your client. So that's a very important point to make. The second is that I think a high level overview of all of these moving parts, but probably a message of, we've got to buy some time over the next several months. James just talked about, 4 months that you're going to see a lot of movement in, particularly as it relates to a lot of these credits. I think that is just going to take some time to move that through the system. If a client is going to do some home repairs, et cetera, you probably want to get them to be thinking about the next year if they haven't already started it. So I think those are we can't go through all of them, but those are the types of points that I think you just got to have some honest brokerage answers. And just like in the government assistance programs, and we're still seeing in the earned income in the ERC, there are going to be a lot of people out there passing out bad information, almost in a fraudulent way about getting credits and getting these types of things. And you really, I think, need to convince your client that they need to be very careful before they react to some unsolicited advice in some of these other areas.
Thanks, Barry. So, and we've got 9,000 attendees on today, so we've got a lot of interest in this topic. So, James, I'll let you clear this slide.
Sure. I raise this because I think tax people find new tax concepts to be interesting. So one element is it's called direct pay, which is essentially making these tax credits refundable for a small group of taxpayers. The theory being that we used to have the 1603 grant program where people would just get a check from the government. This time we're treating it as if it's an overpayment of your estimated taxes. So conceptually it's similar, although the mechanics will be a little different. That will be a lot of taxpayers on the generation side and on advanced manufacturing are eligible for those. So we will see that. And the new CHIPS Act has direct pay component. But the one that the one that's probably I'm getting 50% of the questions on, and there really are not many good answers, is the concept of transferability. So now a lot of these tax credits contained in the bill, the majority of them, taxpayers will be able to sell them. It'll be treated as if it's essentially a non-taxable sale to other taxpayers. And so there are tons of questions about that. How do we do recapture? Which party is the one that has to recapture? And if you think of it in it's sort of a continuum, on the one hand, we had sort of the old rules where the partnership rules limited the ability of partnerships to get together, where really all you were doing is transferring tax equity to another partnership. You could do it, but there were a lot of restrictions. This loosens up many of those restrictions to make it easier for taxpayers to buy other people's tax credits. But they didn't make any changes to the passive loss rules or active participation rules. So this isn't going to be as generous as we used to see in many states where they have a really active, robust state tax, tradable credit program where in many states you can get a variety of different incentives. And essentially there's, at the end of the year, you can sort of purchase whatever the state tax credits. It doesn't go anywhere near that. Now it may in the future, but it doesn't now. So it is an interesting change in policy, and there's a lot we're going to have to learn about that.
Yeah. So before we came on the air, I asked James this question and he punted. So, but I'll just say, with the buying the non-taxable sale of tax credits, a whole host of unanswered questions. What happens to basis? How do you even account for that transaction that it goes to inside of a pass-through entity? So a lot more to come from that standpoint, but it's going to be, I think, a great planning opportunity once some questions get answered.
So, James, we look forward to having you back on again. I mean, what we did today, we didn't get into Barry and James, the corporate AMT, lots of other topics in the Inflation Reduction Act, the new IRA. We are going to be having a tax team webcast next Wednesday from 1 to 2 p.m. And we'll start breaking down what you need to know. And what we're doing here is just like what we did with Business Relief. We're bringing you the best available information we have. And there's clearly going to be, guides coming out and better documentation that you'll be able to leverage with your clients. Hopefully even today, some of today's slides, you can leverage with your clients. So thanks, James, for being with us. Any concluding remarks you want to provide the audience? We got, as I said, we got 9,000 people listening.
No, thank you for having me. And I think it's going to be a good time to be an accountant, because all of these, the difference between book and tax has suddenly become very important where it wasn't as much before. So we will be very busy.
A lot of planning out there as well.
It is good time for the firms and the CPAs out there. Thanks. So we'll be in touch.
Great, thank you.
So, thank you. So Barry, there were two other, and there's been a lot of comments that have come in related to the student loan forgiveness. So we want to kind of hit that quickly. That's another, potential, I guess, $300 billion in government funding being thrown at these, canceling of these student loans, and then also the late fee announcement. But maybe let's start with the student loan forgiveness.
Well, I hit that one to begin with. I think there's a lot of unanswered questions. I know that's a sort of a theme for today. We know that there's some debt forgiveness income potential at the state level. There's an unanswered question, or many state levels. There's an unanswered question depending on how it actually gets implemented at the federal level. We'll get that as quickly as we possibly can in that process. There's also going to be a lot of equity questions that people have on what if I just entered into a loan? What if I just paid off of a loan? There's going to be a lot of things that go into it from a planning perspective. But the tax component is going to be important to get answered. And we know that there's going to be some state tax ramifications on that side. Now, on the service issue, or I'm sorry, the late fee issue, we've been advocating, as all of you know, for turning off the penalty machine, as we like to talk about it. And this is a step. This is something we've been advocating for. So this is a good thing. It's not sufficient. It's good, but not sufficient. It doesn't really address it's a late filing a waiver. It's probably not going to eliminate much of the backlog. There's some estimates that it could be about 10,000, 15,000 in the backlog issue. Clearly, late filing fees that have already been agreed to, there's going to be a refund. So some taxpayers are going to be positive about that. But it's the volume that has been about this process is not going to be resolved, including where people have used their one-time forgiveness point that exists as it relates to the penalties. If they've already used it on a late filing fee, will that be reinstated? Late filing penalty, will that be reinstated? That's an unanswered question. It's one that should be, yes, it should be reinstated. But the bigger picture of service still remains. While this is a step, it is only a step, and it does not really address the issue from a total perspective of where this really needs to go.
Well, in the AICPA, as you said, I mean, we've been highlighting all of the advocacy that's been around late fees over the past many months. So it's good to see a start here. Hopefully more to come, and we will be providing more information related to the student loan forgiveness in upcoming town halls. So Barry, we're now going to pivot and bring Carrie Hipsack up with Carl Peterson to continue on. This is a power hour, so we'll hand it off to you. And, Barry and I will be back shortly.
It definitely is a power hour. Carrie, Barry was mentioning he referred to the IRS backlog a few minutes ago, and we've talked about that before, and firms talk about that all the time with me, wanting to know where we're at, what's going on with all that stuff, and a lot of that has to deal with paper processing. So what's the latest news on technology the IRS can use for the processing of paper returns?
Yes, thank you, Carl. Absolutely. Paper is an issue at the IRS. And the National Taxpayer Advocate, Erin Collins, recently wrote an appeal to the IRS for one of their decisions that they had made in regards to one of her taxpayer advocate directives. So the link on the screen will direct you to the latest news. The following bullet points is just a little bit of background. The taxpayer advocate directive that is cited here is actually back from March. She being Erin, pushed the IRS to adapt barcode scanning and to give a timeline of implementing this new technology by the 2023 filing season, 2024, if absolutely necessary. And the IRS responded back saying that they're already working on it, basically, in short. They also mentioned that they expanded e-filing and that they're not going to commit to any option until they've fully investigated all the options and are confident in it. And in summary, they revoked Erin's taxpayer advocate directive. That's the TAD. I know we love acronyms in this profession. Erin came back and she wrote a very thoughtful response with very detailed information about why she chose to appeal this revocation of her TAD. So in this link that you'll see, it does go out to some of the other source documents, including a blog that came from Erin. And I thought it highlighted very clearly what some of the key issues are. Carl, you mentioned the paper being a problem, and she cites that as of July 1st, the backlog was at 17.4 million of unprocessed returns.
Wow.
Right. And in true accountant fashion, I love that she broke out some of the repercussions and some of the limitations of the IRS trying to meet their deadline of processing all these returns by the end of the year. And using only 1040s, she looked back at what the weekly average processing rate was of paper tax returns, and it was at 295,000. Now, to meet the deadline that the IRS set for themselves and expectation for taxpayers that the backlog of paper returns would be addressed by the end of the year, they would have to work through 595,000 per week for the rest of the year. So it was a very interesting article, very enlightening about what type of manpower it would take to process those returns, which further supports this idea that the IRS really needs to step up some of the technology that is used in processing returns.
Yeah, for sure. It's hard to wrap our heads around that backlog and how they're going to accomplish that. There's a lot of challenges that the IRS has, and I know they want to address them all. Excuse me. As we, I was thinking about the Inflation Reduction Act and the clarity that we're going to get and the guidance we're going to get coming out. This technical section of the town hall is super important. We're going to have more to come on that. But I think you have some updated resources now, right, on the recovery programs that we've covered before in past town halls?
Yes, I have mentioned the Shuttered Venue Operators Grant Program a few times. The last town hall was in a little bit more detail. And I realize that not everyone has clients that received these funds or are an entity that received these funds, but I want to help to make sure that everyone that needs this information is aware of this information. On this slide, you'll see 3 links that go out to some of the resources that were released by the SBA for the SVOG, getting tripped up in those acronyms, for what requirements need to be followed when it comes to following those federal requirements to provide information about how the funds were used. There was that 9-month audit submission extension that was for the later of 9 months from the date of guidance, which we can see now is available. So that was the news last time. We were waiting for that guidance, and now it's available. In the recently released resources, there is also some clarification about the revenue audit threshold trigger. In the past, I've mentioned that typically single audits are triggered by expenditures, but due to the nature of this program, it being the single audit is triggered by revenue. And within the guidance, it talks about whether to use cash or accrual accounting. Right now, it says it depends on the ordinary business practices. And our Government Audit Quality Center, GAQC, again, another acronym, is working to get some clarification. They've asked for examples, some best practices, et cetera. So we will report back once we hear more on that as well.
Yeah, that'll be great. That, while there may not be a lot of firms that, have been involved in the Shuttered Venue Operators Grant Program, there are still a lot of firms that are, right? They have a lot of clients and they're very focused on that area. So this guidance is super important. One of the other things that we've read about over the last several months during the pandemic and COVID and the relief programs is all about fraud. So I think you have an update maybe on that is very important for firms to hear on what's happening going forward on that.
I do, and I know that's exciting news, but first we're going to talk about the coronavirus state and local fiscal recovery fund guidance for a quick second.
Sorry.
That is fine. Everyone is going to be excited for this now, but real quick, for CSLFRF, there is an alternative compliance examination engagement that can be accepted, again, to meet those requirements of attesting to how federal funds were used. And there is a Treasury portal that can be used temporarily. There is talk about using the Federal Audit Clearinghouse, but right now, again, follow that user guide, follow that guidance, and use the Treasury portal to make sure you're in compliance with any details about the use of these funds. And now we're going to get to the good stuff, Carl. I know everyone's excited to hear about this. On the town hall, we get a number of questions, it seems like every week, about what is going to happen to those individuals that have used PPP or EIDL funds fraudulently. And recently, there have been two bills. I didn't name them. I figure we give you all enough acronyms, but there were two bills that extended the statute of limitations for prosecuting those who have fraudulently used PPP or EIDL funds. This applies to PPP first or second draw and EIDL, the loan EIDL, the EIDL advance, or the targeted EIDL advance. So I think that's good news for some of our attendees that are always interested in making sure that those taxpayer dollars are used appropriately.
Excellent. Thanks, Carrie.
Carrie, thanks, Carrie, for those technical updates, and we're going to move into Carl's corner. But just one comment on the last slide. I mean, we knew that back in the spring of 2020 that there were going to be follow-up investigations, and these programs were based on, self-affirmations. We know when the firms were working with clients, things were done in a high quality and with lots of integrity. But just like the tax system, sometimes people try to cheat it, and they're gonna get caught. So with that, Carl, let's move into the top issues that you're seeing for the audience here. Carl leads the small firm section of the AICPA, and he's meeting with small firms around the country on a daily basis. So Carl, I'll let you clear the highlights here, and Barry may jump in with comments as well.
Yeah, no, that'll be great. We know the top issues. I think, the very top one is staffing, and we always talk about recruitment and retention. But what I wanted to share today was I think some encouraging signs of what firms are doing. Talking to firms around the country, I'm hearing firms are starting to raise compensation for their new staff coming on board. It's a slight rise around the country, really across firms of all sizes. Some have gone with, I've heard of a base compensation of, let's say, $60,000, but maybe an additional $5,000 if that new staff person is a CPA already. They passed the exam, and some are paying that $5,000 as a bonus, not necessarily adding it to the $60,000 as a annual compensation. I'm further encouraged by another medium-sized firms that have told me that they've hired new people and they're starting their new people out today at like $70,000, whereas a couple of years ago it was probably 55 to 60. So we saw some increases going on the compensation side, which I think is encouraging, because I think we've got to become competitive, with all the other professions that are, trying to attract the same people that we are. They're also working on increasing benefits. One of the things I don't have in that slide is that we see, if they're not doing it with compensation, or maybe they're doing it in conjunction with compensation, is increasing the number of days off, increasing primary PTO primarily, and also encouraging staff to take time off in week blocks versus a long weekend here and there. They're really trying to encourage staff to do that, which I think also addresses the whole wellness aspect of staffing today, and encouraging those the staff to stay around within the within the profession. I have technology on here as well. Oh, by the way, ghosting, and somebody asked me about that when we were going on the slides the other day. It's amazing to me that there are people who have been hired and they've accepted an offer from a firm, and this happens all across the country, which, like I say, amazes me. And that staff person's ready, is supposed to be starting the next day or starting on Monday or the first of the month, and they don't even show up. They never even say anything. They never talk to the firm again. That has happened around the country as well. And I think what they're really looking for is to make sure they have that right work environment, the right culture of what they think might be right for them. And so, it seems like the firms that are successful have really had that flexible environment, hybrid working, things like that, allowing people to come in so many days a week, but have the total flexibility and giving them really let them use their professional judgment on what is required to get the work done. I have listed on here also leveraging technology. There's a lot of firms, they've been doing this since the end of tax season, maybe even during tax season, trying to figure out what is the best technology to improve the processes that we have, become more effective, but primarily looking to try to reduce the number of hours that seems to be required for their staff to work during tax season. So if they're working 50 or 60 hours a week, they're looking for technology to reduce that. Everybody's trying to get down to that 40-hour week if at all possible. And, I think, we can do that. And if you look at, I think there's if you look at the recent or even historical CPA.com Startup Accelerator program companies, there's a few that stand out that'll actually reduce that time spent, I think, on everyday recurring activity during tax season, and also in the assurance or audit space as well. Business model changes. It's also encouraging, I think, to hear what firms are doing with fees. I was surprised over the summer how many firms, and medium-sized firms as well, that are really moving to subscription pricing and value billing. It's becoming more and more prevalent, and it just seems like now it's almost like they're talking about it like it's nothing new. It's something that they've been doing, so it seems to be working out very well for them. And I think we'll see an increasing use of that as well. Minimum fees for tax prep is going by firms of all sizes, and some firms as high as $1,500, which, especially in the small firm, medium-sized firm world, that's a big minimum fee. So we're seeing that happening. And I put on here succession planning. I think if you look at our PCPS top issue survey that just came out this year in 2022, succession planning dropped out of the top 5 for firms of all sizes. But it's been the hottest topic this summer. When firms reach out to me, I go to sessions or conferences, people are always talking about mergers and acquisitions. And we track what we can, what's happening in the public market with the larger firms. And we know that it's trending higher than we've seen in the past several years. Large firms are, we know the private equity deals. Larger firms are getting together, merging for sustainability and moving into the future. And more small firms are merging not only together, but moving into the larger firm space. So like I said, it's one of the hottest areas. Why don't we move to the next slide?
Yeah, Carl, we'll hit this. Let's Barry and I a quick comment just on what you just covered. I mean, with the staffing, it's just, the year's moving so fast, and you look at, the kind of headwinds of the economy. So you've had, it's good news, some adjustments in starting salaries to attract more people into the firms and into the profession. But there's also a little bit of self-correction going on. And now, in some ways, I think the firms are going to be thinking about, what just happened with this huge bill and other complexities.
Yeah, the 3 quick points on what Carl just covered. First off, he was talking about salary numbers, but that was just a general, sort of trend, national basis. Every metropolitan area, every state, every rural area has different answers to that particular process. So let's just put that out there. Yeah. I think the mergers and acquisition activity, even in smaller firms, among smaller firms, very sole proprietors, et cetera, that's certainly happening, and it's certainly playing out with the change in technology capabilities and the like. And on the workload issue, I'll just remind everyone, we do have a project underway that is in our tax division that is actually looking at how do we deal with due date issues and extensions. How do we make them more practical so that they're not as time consuming? What things can we get done? And we have all different sort of the generations, so young people as well as seasoned professionals that are trying to wrestle with that. And we know it's controversial because everybody disagrees with any particular answer, but we are trying to look at that issue in a holistic way, and some of it might even take legislation.
Yeah. Well, thanks. So, Carl, let's hit this one. Then we're gonna jump into open forum here as we're getting close to the end of the hour.
Yep. 2 quick comments. The first thing that firms need to do is really manage client expectations. We have the 9/15 due dates coming up here with pass-through entities. You've got to set the deadlines with these clients for that client data. If it's not in already, you need to set that deadline so it gives you the time and your staff to get those returns completed. And I think it's important to hold true to those deadlines no matter what. Otherwise, that client will never change. And I think you can look at your client base, and year after year, it's the same clients who are late. It's the same clients that you're always pushing on. So I think you need to hold true to those deadlines and start to manage the client expectations to be where you need them to be. Secondly, we put on here project management, customer service. Even in smaller firms, what can be done, and what we did before I came to AICPA several years ago is that we assigned an individual to really track down the data during crunch time, during the tax season, during the busy season. And that person ended up becoming that #1 contact during those times. We kind of offloaded that busy work to that person to track the data down, work with the clients on uploading data into the portal if that's what was necessary. And it really created another contact person for that client. It increased the stickiness of the client with us, and they had another person to talk to, which really allows you as the professional to work on the things that you really need to do. So I think these are the two primary things that firms can do today if you haven't done it already.
Well, thanks, Carl. I mean, that's good overview and kind of top of mind issues for the small firm community. What we're going to do now is we're going to actually take the open forum more to online. I appreciate we've got close to, I think, 500 questions here with the 9,000 attendees. We really appreciate this engagement. We take these questions back. We give you the top questions in our newsletter next week, which we address. And we also use this for our planning for the next town hall. One thing that we will cover in the next town hall is more information about ERC, some of the delays that are occurring out there and getting the payments to your clients, and also the cottage industry. There's a huge cottage industry around ERC, ERTC tax credits, and we'll talk about some strategies and how best to manage that. So thanks again, James, for being with us. What I'm going to do now is just with Barry here cover some resources and then sign off. So here's the summary. A lot covered today in this Power Hour with you. You do have the past town hall series. I mean, Carl today just mentioned subscription billing. We had James Baker on, Ron Baker on in July, and he was talking about subscription billing. Next town hall, we have Marcy Russell back with us, and she'll be giving us the quarterly economic update. That'll be a very timely discussion with Marcy. One other thing that we're highlighting here is a growing CAS offering around spend management. As we move into these tougher times, firms and clients are looking for better tools to leverage and to manage the spend in a proactive fashion. Here's a webinar that was done with Accounting Today with practitioner Steve Cheney, who's been leading a CAS practice for the past decade plus. So this is a webinar you can take advantage of. It's a on demand, so you can fast forward to sections that are most relevant for you. I also want to highlight the 2022 Accounting Pipeline Diversity Symposium. Here on this slide, some information related to that and details on how you can register. We greatly appreciate the dialogue that we have with many of you on social media. It's an important way for us to get our message out. So highlighting a couple of mentions here in about the last town hall. So we'll be back with you on September 8th, Barry. This was a fully packed hour. So any closing comments for the audience?
I think the trusted advisor role says lay the facts out to your clients and to your colleagues and the people you interact with, flat out about the armed agents, about the tax gap, all of those things. I think it's our job to remain calm and to be able to look at all of those things and understand what's the political rhetoric and what's really the substance and communicate that.
Well said, Barry. It's great being with you here in person in New York. So hope all of you have a good end of August and a Labor Day, and we will see you on September 8th. Thanks for attending today.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.